Hello, my fellow investors, and welcome back to another fundamental analysis video now in 2025. Boy, it's going to be a crazy year. So we're going to take a look at the company, guys, ConocoPhillips. Now, this one was actually brought up by Justin J. Will on Rumble, asking, after my own research, I ended up going with ConocoPhillips, not wanting to beat off to a dead horse, but can you do a video on them? I love your videos. Thank you. Yeah. So since this is the first, recommendation on Rumble, let's actually do it. ConocoPhillips, guys, let's take a look at what they do. Let's take a look at their past earnings and their upcoming earnings, as well as the overall projections for that. Then we're going to take a look at the discounted free cash flow, the profit metrics, the dividends, and all of that, and then my overall thoughts on them. So before we get started, make sure to like, subscribe, comment. If it does help with the algorithm on YouTube, as well as Rumble, make sure to follow us on X at Fatal Investing. If you'd like to join us on Discord, which is the best place to catch the videos, live streams, and the shorts, link to that is in the description below. It is available for free. So with that said, let's get started with this analysis. So jumping into now the company profile, we got, well, first of all, obviously the company, it is an energy company. And you guys know I do love my energy companies, right? 123 shares of Chevron and still going strong with that one. Hopefully, as I said, guys, Chevron's looking good right now, but this video is not on Chevron. Let's take a look at the company profile. ConocoPhillips explores for, produces, transports, markets crude oil, butadiene, natural gas, liquefied natural gas (LNG), and natural gas liquids in the United States, Canada, China, Libya, Malaysia, Norway, the United Kingdom, and internationally. The company's portfolio includes unconventional plays in North America, conventional assets in North America, Europe, Asia, and Australia, global LNG development, oil sands assets in Canada, and an inventory of global exploration prospects. ConocoPhillips was founded in 1917 and its headquarters in Houston, Texas. Great state. But it's actually really interesting. So they seem to be, guys, doing a lot of upstream as well as midstream, not necessarily any downstream, which is interesting. Very, very interesting. So obviously with the midstream, I mean, you're pretty much getting 2/3 of the oil market just from them alone, which is a really good overall, I guess you could say, exposure to the energy sector. So really, really good to see right there. 10,300 employees. Again, 1917 was the year that it was founded at. Taking a look at these past earnings, we can see that their earnings was on Halloween, October 31st. EPS normalized estimate coming in, EPS normalized actual coming in at $1.78, beats by 14 cents. EPS gap of $1.76, beats by 11, and revenue of $13.6 billion, beat by 32.22 million. Now, the next one is actually expected, hey, February 6th, my birthday. We got the EPS normalized estimate at $1.81, EPS gap estimate $1.87, and revenue of $14.22 billion. Wow, 17 revisions, 13 to the downside, only 4 to the upside. This is not like a complete one swing to one side. So if the earnings actually come out to be worse than it was expected, and this thing falls, by the looks of it right now, I mean, we haven't done anything else, but it does provide, it would provide basically a pretty good entry point at a much lower price tag. So let's jump right now into the spreadsheet. We got the ticker for COP, market cap of $128.3 billion. PE, I love this PE, 11.77. Guys, anything under 20, I think is a really good price tag for me. So I look at this, I'm like, with a current share price of $99.17, it's looking a little bit promising here. And the charts actually look very interesting. On the 1 year, this is down 15.66%. Now, because it's the new year, we don't have a year to date anymore, right? So as of the 1 year ago, it is 15.66 down, which is tremendous. In fact, the 52-week range is near that 52-week low. And you guys know 52-week low companies, or at least near 52-week low companies, are a great starting point to find a great investment. Again, 52-week low of $94.23 and a 52-week high of $135.18. Coming back over here, we can see that they do pay out a dividend of $3.52, which is a yield. It's a pretty good yield, 3.55%. Payout ratio of 42, almost 43%. A whopping 5-year CAGR of nearly 17%. This means that in the past 5 years, their average dividend increases has been around 17%. Raises. That's absolutely crazy. 4 consecutive years of dividend payment. That's looking a little bit sketchy. If we take a look at the dividend history, we can see that it's a little bit all over the place. It's actually very, very difficult to just Oh, okay. So they used to pay it semi-annually, and then in 2022, actually, let's take a look at this. Yeah, so they used to pay it semi-annually, as you guys could see. It's not consistent, but I do see the fact that they did change it from. Oh man, even I don't know what's happening here. So so they used to do it per quarter back in 2020. You guys can see right there. And then out of nowhere, they started doing they started doing a lot of special dividends. Okay, I see. I see what's happening here. So they did a lot of special dividends in 2022 and in 2023, probably due to the fact that oil was just skyrocketing, right? $124 per barrel. That's probably the reason why this occurred. And you can see that now they're back to normal. I don't see this as a dividend yield or dividend safety as too bad. I think it mainly has to do with all the special dividends as to why this isn't more, but it is what it is. I personally don't see it as too much of a big deal. Ex-dividend date passed as of November 8th. Payout date was on December 2nd, and they do pay their dividends quarterly. So with all of that said, we can see that based off of the current shares outstanding and this $3.52 in annual dividends, they pay out a whopping $4.1 billion every single year. Take their 10-year average free cash flow, subtract this number, they're left with $1.75 billion left. And if you do the same math, taking their last year's free cash flow, this jumps up to $5.2 billion. That's a great jump. I want to see, though, if it's a trend or not. Because if it's a trend, that's great. If it's just an outlier, that's not necessarily that good. These payout ratios are 43.82% for the last year's free cash flow, and for the 10-year average, 69.76%. So the last year's free cash flow is looking very, very good. Yeah, we'll see how the overall trend looks like when it comes to the 10-year average. So jumping now into the profit metrics and all of the graphs in general. First things first, I gotta mention is that this 1 year ago value is actually 2024, okay? It's not fully updated. It's a little bit lower because we have to wait till, Q1 earnings so we can get Q4 earnings, right? That's usually how that works. So we got here 10 years ago of negative $4.43 billion to today of almost $10 billion. That is an increase of 325%. It'll probably be a little bit higher, but you guys can see that this graph is pretty much all over the place. Now, the one thing when it comes to oil companies, especially one that does oil exploration, understand that this is very, very much tied to the overall oil market. So why this was negative 10 years ago, 8 years ago, probably because crude was in the negative, but you have to do a little bit more research than that. Don't necessarily know as to why this one was down like this these past years ago, so I'm going to give this guys a 55%. Looking down to the free cash flow, cash from operations, less capital expenditures, we got 10 years ago of negative $2.5 billion to 1 year ago of $9.3 billion or $9.25 billion, increase of 473% with an average of $5.81 billion. Now, okay, this was again negative 10 years ago. You guys could see that the 8 year ago value is in the positive, and even the 5 year ago value was in the positive as well. 5 year ago, guys, COVID, right? COVID. So that's perfectly explainable as to why that is. Oil went negative, massively in the negative, right? Negative $37 per barrel. So that's perfectly explainable. The following years, it did go up. However, 2 years ago, it did come down to 8.7, and right now it's slowly coming back up. So I look at this, and I'm like, the negatives are explainable, or at least I would say they're kind of explainable. And this is perfectly fine because of COVID. The fact that they're positive is actually really good. I'm going to give this a 65% for an overall grade. Now, the revenue is actually looking really good. We got 10 years ago of $30.23 billion or $30.22 billion to 1 year ago of $57 billion or so, increase of 88.37%. Once again, we see the down year here 5 years ago, COVID, perfectly understandable. We can dismiss that. Massive jump, and right now they're kind of just stabilizing one more time. Overall, 75%. Yeah, I'm going to give this a 75% just because we can see here that, well, obviously revenue can't be negative, but the overall graph does look a lot better than that of the previous two profit metrics. Now, the assets as a reference only, we can see that it is kind of stabilizing. It has come down, but it is coming right back up. Okay, it's not looking too bad. The liabilities are actually looking really good. Yes, they did jump after 4 years ago. However, we can see that it is pretty stable as of right now. And the average total assets minus the total liabilities, kind of flat from basically 7 to 4 years ago, and then spikes, and now it's remaining. It's slowly increasing after that. Average total assets of 87 billion, liabilities of 46 billion, difference of almost $41 billion. I think it's 75%. Then the cash flow minus the liabilities. Okay, this actually isn't looking too bad. Well, I wouldn't say consistently increasing, but it is very nicely increasing from 10 to basically 6 years ago, came back down 5 years ago, that's fine, and then got really, really close to zero and negative $21.1 billion 4 years ago, but now it's coming right back down again. The average is negative 40.5 billion, and currently they are at negative 37.4 billion. Overall, I'm gonna have to give this a really good grade. I do like this. I'm gonna give this like a 90%, guys. It's looking really, really good. Then the shares outstanding. This is where things usually fall apart. However, we can see that this actually isn't that bad. From 10 years ago, we got 1.23 billion shares to today of 1.15 billion shares, a buyback of 6.54% on the 10-year, and previous year to the current year, another buyback of 2.31. Now we can see a pretty consistent buyback. I wouldn't say consistent. They did increase it from 9 to 8, but it's consistently decreasing from basically 10 to 4. Spike as of 3 years ago, but now they're decreasing it again. I have this as an 80. Honestly, I'm going to bring this a little bit higher. I'm going to say this as a 95%. It does seem like they are managing their shares, issuing and buybacks very, very good. And lastly, cash equivalents. They currently hold $5.2 billion with an average of 4.8, almost $5 billion. Overall grade for me, actually 73%. It's not looking too bad. My biggest concern here would be the profit metrics, honestly, and it's just the choppiness of it, but that could just be attributed to that of oil, how it was back then, right? I don't necessarily know what oil was doing 10 years ago, like out of the top of my head, but most likely that was the case. Overall, though, 73%, it's not looking too bad. Now let's take a look at the discounted free cash flow to see if, at the current price, with this current PE, is this a buy? Because yes, the profit metrics, all of these numbers are looking great. I would say great, but okay. But now, is this price tag a good price to buy this at? Let's find out. So now taking a look at the discounted free cash flow. I already preset this, but this is looking very interesting right here. So guys, in the past 10 years, they've increased their revenue at around almost 23%. Now, I'm not going to put 23% for any of this because that's a little bit rosy and it's not been consistent enough for me to actually do that. But for the revenue, let's say lowest assumption 15, median 18, and highest 21%. All right. Again, in the next 10 years, that's a long time, right? That's a long time. Now, for the share buybacks, they have been buying back on average at around 0.5%. So I'm going to go with basically issuing 0.5%, not doing anything, and then buying back 0.5%. And with a required rate of return, actually, let's remove the required rate of return for 1 second. Not inputting the required rate of return, we got $1,029. Basically, we got $1,030 for the lowest assumption, and the highest assumption a whopping $2,044.50. And adjusting for debt, it's actually roughly the same, which is really good to see. It's only off by around $5 or so. Now $1,023 to $2,038. So putting in the required rate of return now, let's put in 12%, as I had before. This number drops to 163.24 to 283.40. Not adjusting for debt, and then adjusting for debt, $158.04 to $277.66. We had the margin of safety 5, 10, and 15, 134.33 to a whopping $263.77. I look at this and I'm like, this is, the price tag is less than 100. It's $99.17. This is incredible. My one area where I'm just a little bit worried of is the profit metrics. They're just a little bit too choppy, but honestly, I see it, man. I see it. I look at this and I'm like, this is it's a great company. I'm not gonna lie about that. Like, honestly, if I didn't have Chevron, this would be the one I would buy right here, because these kinds of numbers look really, really solid, in my personal opinion. Again, not financial advice. Every single investment is the present value of all future cash flow, which is why I give these calculators out for free so you guys can make your financial decisions for yourselves. Because at the end of the day, my numbers may look different than your numbers, right? You might think that they'll do, 20, 25, 30% in revenue increases in the next 10 years. I don't know. So with that, you have to make that decision for yourselves, which is why I give this out available for free. It's again, not financial advice. And every investment is the present value of all future cash flow. At the end of the day, though, I do like these fundamentals in general and where it's currently valued at. And lastly, if we take a look at the dividends, putting in $6,215, this nets you around 62.67 shares, or a whopping $220.60 in annual dividends, guys. Absolutely incredible. I actually really do like this dividend yield. I mean, 3.5% is really, really good. $220 is looking absolutely great. So overall, when it comes to ConocoPhillips, if I didn't have Chevron already, I would definitely be buying this one. And this one's still under $100, guys. Again, valuation does look pretty good. Fundamentals are I'm a little bit worried about it. But then again, the fundamentals for Chevron aren't stellar either. So yeah, it's honestly looking good. And hopefully this helped. So thank you guys so much for watching. Make sure to like, subscribe, comment. If that's helping with the algorithm on YouTube as well as Rumble, make sure to follow us on X at Fatal Investing. If you'd like to join us on Discord, which is the best place to catch the videos, live streams, and shorts, the link to this in the description below is available for free. So with that said, guys, peace out, and we will see you all next time.